One area of confusion we often clarify in meetings with clients is the difference between cash flow and taxable income. Clients often assume that if they withdraw money from a non-registered account, they will automatically pay tax on that withdrawal, which is not the case. The original capital in a non-registered account is already after-tax money, so it can be withdrawn tax-free. However, any income generated, such as interest, dividends, or foreign income, will be reported on tax slips, typically a T5 or T3. Early in our conversations, we ask clients to outline their cash flow needs for at least the next 12 months and ideally 24 months. This includes ongoing withdrawals, such as monthly transfers, as well as any larger one-time expenses. Cash that is required in the short term is typically held in an investment savings account. These are designed to generate income while remaining liquid and secure. We set aside 12 to 24 months of expected withdrawals in these accounts so that we're never forced to sell investments at the wrong time in the market cycle. We also segment cash based on its purpose, whether it's for an upcoming withdrawal, future lump sum, or potential investment opportunities. This ensures that funds intended for one purpose are not unintentionally used for another. When clients need cash, we often look to the non-registered account first. If needed, we can raise cash with minimal tax impact by using existing cash balances or selling investments that are in a loss position. Alternatively, if it makes sense from a planning perspective, we may realize capital gains intentionally, especially in lower income years, to make use of available tax brackets. There's also situations where generating taxable income is beneficial, even if cash flow is not required. For example, in a low-income year, we may recommend withdrawing from an RRSP to utilize lower tax brackets. For clients with RIF accounts, the strategy varies. Some clients will take only the minimum required withdrawal, while others may benefit from withdrawing more than required in order to smooth out income over time and reduce future tax liabilities. Tax-free savings accounts are not the first source of cash in the hierarchy, as we want those assets to continue growing tax-free. However, in high-income years, they can be used as a useful source of tax-free withdrawals if other options would create significant tax consequences. Ultimately, our role is to manage taxable income over your lifetime, not just in a single year. We focus on smoothing income over time to avoid large spikes in higher income tax bracket years. In many cases, realizing income earlier at lower rates is more effective than deferring everything and creating a large tax liability in the future. At the same time, once we understand your cash flow needs, we ensure that those funds are properly set aside so that your investment strategy is never compromised. If you like this video, you can discover more videos in the Greenard Exchange section of our website. You can also read both past and current articles in the Greenard Index section. Thanks for listening.